Hello guys, in this clip, Mohnish will talk about what he learned since 2020. In this clip, you will learn 1. What are the two things that matters? 2. Why you should sometimes forget about valuation. 3. Why you should run your portfolio as a museum. 4. Why you only need 100 bagger. 5. Why the best investors are not investors but business owners. 6. Why running a concentrated portfolio is the best way to invest if you have the right temperament. And 7. Why Amazon and Apple are not 100 baggers material. Enjoy this amazing interview.
So the simple math here is there are just two things that matter. The first thing is a periodic check on, is the business getting better? And of course, business doesn't go up in a straight line, so you have to take out the noise. But in general, if you're seeing that the moat is intact and the moat is widening and deepening, then forget about the valuation. Then the second part, which is the valuation, is, like I just said, forget about the valuation. If it gets egregious, not overvalued, but egregiously overvalued, then you can take a look at it. So, for example, if I think this Turkish business is worth 2 billion at some point, and the market is pricing it at 20 billion, for example, we would probably not be a shareholder at that point, or even much before that point. But it would have to get to significant, egregious overvaluation to doing that. And so the third part of this journey is that if I can find these 100 baggers, or at least companies that look like decent candidates, that over a 10 or 20 year period they could get there, then we become a portfolio becomes a museum. And we become a collector of these 100 baggers. It's great from a tax point of view because we just sit on them. And the idea is that we only really need one. I mean, the Turkish business might not do it for us because it was such a small investment. We put like a little over 1% of the portfolio into that. But if I could make a $50 million bet, and at some point it became a 20, 50, 100 bagger, it would become a very significant portion of the portfolio, and we don't really need the rest of the portfolio to do that much. So the rest of the portfolio is still not slouches. So Berkshire has underperformed the S&P for Nick, but it's still gone up in value. Costco probably has matched it over this period, but it doesn't matter. It's fine. Those two have added value, and then you have one with kind of high octane returns, and so that has worked out really well. So these are some of my blessed COVID learnings. So in many ways, I think maybe I should be grateful for COVID because it put an end to my travel, gave me more time to contemplate my navel and try to understand what's going on. And I told Nick that as soon as international travel opens up, I'd love to have dinner with him. And he's excited about that. So that would be my first trip leaving the US will be to break bread with Nick and Zach, and that'll be great.
Don't forget to like and subscribe if you haven't done it already.
Nick's point was that an investor in Walmart or an investor in Amazon or Costco or Berkshire should have the framework which the founders or the owners of the business have. So the Walton family basically is not interested in selling Walmart stock. And they just held it throughout. They held it even after Sam Walton went away and even after the next generation has started going away. So it's been a multi-generation hold. And, the same thing applies to Berkshire Hathaway and to Amazon. Now, one of the things that happens that if you are exceptionally good at this, if you do really well at this, and you're running a pool of temporary capital, like Nick Sleep was running, what is going to happen is one stock is going to become 90% or 95% of the pie. And most institutional investors and money managers would choke at that. They would never allow that to happen. And I think that's ridiculous. So what I think should happen is that once you're starting to get concentrated, don't let new investors come in. So kind of freeze the capital and broadcast loud and clear to everyone that fasten your seatbelts. We're not selling these positions. We're going to be holding on. And if you don't feel comfortable, you can exit. But we're not going to cut the flowers and water the weeds. And going back to the Upanishads, I shifted my thinking to 100 baggers. And so obviously, the Amazons and Apples and Googles of the world, if you do 100x from their current multiples, I think it would require quite a stretch of the imagination to get to a point where you thought it was high probability that even in 20 years you would get 100x from here. So certain things. So Amazon probably is a great investment, but at least for me, it's not 100-bagger material. I mean, it was 100-bagger material. I was too dumb to take advantage, but I don't think it's happening from here in the next 2 decades. And so once you shift that framework, different things come into focus. And so, for example, in 2019, which is before my period of enlightenment, I'd been visiting Turkey several times, and I encountered this business in Turkey where the market cap was 19 million and the liquidation value was somewhere between 300 million and a billion, somewhere in that range. And of course, I tried to buy every share I could. And we ended up investing $7 million and getting a 1/3 stake in the business. And so my framework at that time was that this is a good business. It's the number one warehouse operator, lots of recurring revenue, number one operator of private freight cars in Turkey, and a few other very nice businesses. Very good recurring revenue businesses, very good operators, and they created tremendous value over the years. So I said, we'll hang on and we'll see kind of at what point there's a convergence between, our equity position and intrinsic value. And when we get to intrinsic value, we can unload and move on. Well, that framework has changed now. So it's been close to 2 years that we've held the stock. And now my thinking is that, so it's worth 300 million to a billion when we bought it. Could it be worth 2 billion at some point? Because if it gets to a 2 billion value, when we were buying it, it was a 20 million or 19 million market cap. That's a 100-bagger. And a 300 or 500 million or $1 billion business today, getting to 2 billion isn't that hard. And it isn't that hard in 10 or 20 years. So my take now with that business is set it and forget it, And the way we think about that business, the way I think about that portfolio position is it's not a portfolio position. It is a business we are a partial owner of. We are a passive owner. We are a junior partner to the family that runs it. We have no desire to tell them what to do or how to do things. They are doing quite well without any input from us. And life is great. So we just kind of watch from the sidelines.
Thank you guys for watching. I hope you enjoyed. Don't forget to hit the like button and to subscribe if you haven't done it already.